So both the Munro Global Growth Fund and the Munro Concentrated Global Growth Fund had a good third quarter of 2020. Both funds were up more than 10% for the third quarter, and both funds have actually had quite a strong year, with the Munro Global Growth Fund slightly outperforming the concentrated one due to its capital protection efforts earlier in the year. And so when we look at the performance of the Munro Global Growth Fund, the key thing we're trying to flag to investors here is that we're really just targeting that superior risk-adjusted returns through the cycle. We are targeting that double-digit returns or better, and pleasingly, the fund has done nearly 17% per annum since inception. The other thing we target with the Munro Global Growth Fund is just to really focus on those absolute returns. And so what we're trying to flag here is the beta that we're managing to do it at. We're doing it with a lower beta than the market, down here at 0.6. But we're doing it with obviously owning stocks that have a higher beta in the market, and so it's really about trying to achieve that superior risk-adjusted returns through the cycle, and we classify that as double-digit per annum returns over a 3 to 5 year view. When we move on to the Concentrated Global Growth Fund, this is our long-only product, so this is really a relative return product. This is the one that stays fully invested the entire time. It will be more volatile because of that fact. It doesn't have the downside protection tools. And it also, as I said, has had a good quarter and a good year. As we roll forward to looking at how the funds are positioned, both funds are positioned very constructive markets at the moment. We are reasonably constructive on the outlook. The Munro Global Growth Fund is 85% invested, and the long-only product is over 95% invested today. There is a little bit of downside protection tools available to the absolute return product, but from our point of view, we remain constructive markets. We recognise there are some issues on the horizon, such as the US election and such as a second wave of COVID, but we'd be more interested in pointing investors towards the equity risk premium that is available and really the acceleration we see in demand in a number of our areas. And so from that point of view, we think that's being underestimated by the market, and we want to continue to participate in that in the months and weeks ahead.